Good afternoon, everybody, and welcome to our restart of our Meet the Management series. My name is Marc Ashton. I'll be hosting this session today. Just usual disclaimers up front: where we hold shares in an organization, we do share this. I do have some shares in Altvest, Umganu, and Bambanani, which form part of the Altvest cluster. Today I'm chatting to Warren Wheatley, CEO of Altvest. Warren, thanks very much for your time and thanks for joining us today.
Good afternoon, Mark, and thanks for having us, and a warm welcome. I hope all your listeners enjoy the show, or the discussion, rather.
Perfect. Warren, and maybe just before I start, one of the things that has fascinated me, I've been a financial journalist for the better part of 20 years of my life. And this whole question mark about any kind of analyst coverage, small cap coverage, the JSE has always been perceived as being an organization that looks at the top 40 shares on the JSE, and after that the coverage falls off quite sharply. You've gone one step further. You're on the Cape Town Stock Exchange. Obviously they're doing some quite innovative things. I was quite impressed with the registry tool. I used it this morning for the first time to do some voting on one of your items. Maybe just some context from your side around whether the Cape Town Stock Exchange has met its expectations. What's it doing that's innovating from that perspective? And as a listed issuer, what's it doing right? What's it doing wrong?
All right. So, Mark, thanks. Some background. My other day job is the Chief Investment Officer of the Lebashe Investment Group, who are the largest shareholder in the Cape Town Stock Exchange. Now, in that role, I used to manage our investment from a portfolio perspective, and also sat on the board of directors of the Cape Town Stock Exchange in the capacity as a non-executive director. When we listed Altvest Capital, I stepped down as a non-exec director, and also handed over the portfolio management to another colleague within my team. And that was done so to manage conflicts of interest. I couldn't be a CEO of a listed company and sit on the board of the exchange. So I talk as an outsider now, and I don't have the benefit of any operational updates other than what I see from time to time, and what is made available to the public at the same time. So we've always, so I can talk historically and the plans as far as I'm aware, but they may be slightly outdated. So the idea was always to have an exchange where smaller businesses, and quite small in fact, our lowest entry point is a market cap of 15 million under certain conditions, could raise capital. Now, not only equity, but debt as well. And so you'll find that we've got listing rules. The Cape Town Stock Exchange has listing rules for both debt issuances and equity issuances, and a number of different business units around it that support these activities. The registry, number one. Registry, I'm glad you mentioned it, because it's a sort of tool that can assist a young startup, and we use them intensely to manage the management of your share register, the management of your secretarial duties, and a lot of the governance requirements. And so they take a lot of pressure off a young SME that would struggle to do this on their own. And so it's a very useful service. And, they all the way from AGM management, all the way through to minutes, voting, and everything is technology driven, cloud-based. And the idea is to reduce costs and use technology to deploy the regulation efficiently and effectively without compromising on the investor protection mechanisms. Now, building a stock exchange is quite a complex task, because the exchange doesn't exist in isolation. It exists as part of an ecosystem that takes typically hundreds of years to build up. And it's not just the number of investors that use the marketplace to do trades, but it's the entire ecosystem, including brokers, central depositories, asset managers, and all those sorts of things. Now, a lot of the issues that we face that are almost hurdles to becoming a fully efficient marketplace is the following, and it's things that hit you out of nowhere. As an example, I'll give you a few silly examples. There's a real hard cost for brokers to link up to the exchange, and until the cost benefit analysis starts leaning towards the brokerage is paying those fees, it's going to be a difficult sell. Now, what causes that? There needs to be, number one, a reason for, so there's push and pull factors, but quite simply, there aren't enough issuers on the exchange yet to be enough of a pull factor. So we are actively working on some pull factors, and that can be done by putting instruments on the exchange that are not available elsewhere. And I think Altvest has helped a little bit, quite unintentionally, but just a consequence of having a disruptive issuer helps in that regard. So we hope more and more issuers of that nature join the exchange. Something as simple as asset manager mandates with pension funds typically have a definition of listed equity where the JSE is used synonymously with listed equity in terms of Regulation 28. So quite structurally, by contract, a lot of pension funds are prohibited from investing in these in the instruments on the exchange, simply because in a contract signed 30, 20, 10, 15 years ago, whatever the case may be, their mandates only recognize the JSE as listed equity. So there's those kinds of issues. And we are, sort of, as they come up, the team there is trying to deal with them. The idea was and still is to be a platform where smaller businesses can attract and raise capital, provide a platform where investors can get access to these businesses and without compromising the governance and investor protection that comes with a regulated listing. So those are that in a nutshell is what the exchange is trying to do. We don't want to compete with the JSE. We want to be a complementary offering to the investor community in the country. And to that end, we almost could be seen as an extension of the the regulated investment platforms available in the country.
Thanks.
So,
yeah, I mean, I think that's quite insightful. I mean, I think you had a really good interview the other day with the finance ghost. I mean, actually, that was one of the better interviews that I've heard in a while over the weekend. Just talk a little bit about your strategy, and I think one of the things that was, that really came out for me was this almost focus on the real economy versus, how many times can you trade NASPAS, how many times can you trade Sasol, etc. I just grabbed a quick screen grab out of your financial results for the purposes of this interview, but there does seem to be this intent to be able to invest in the real economy seems to be something we've almost forgotten about. There almost seems to be this, financialization of everything, and we forget that, the small businesses around are the businesses that actually are the ones that need the capital and the ones that actually create the jobs. I don't know if you want to maybe talk around that for a little bit.
Thanks, Mark. A couple of things drove this sort of ideology amongst ourselves, and we've got some great examples in the country where it actually talks to this issue. So Bambanani, as an example, we found that once the retail public were investors in the business, they actually, visited the establishment a lot more frequently than they did previously. I think that there's more activity in the place, there's more interaction with the newsletters, and so just as a consequence of having people and their real capital invested in it, there's an enhanced interaction with the business. Number one, just more about what's happening, more about what's going on, and certainly a bigger spend of wallet at that establishment. It's the kind of thing now where instead of reading an analyst report, you can drive past the place, pop your head in and check how many tables are, what the occupation levels are before making a buy or sell decision. Those are the kind of activities we want to start seeing more and more of, where communities are actually invested in the businesses that support that community. The same with Umganu. We have a whole range of investors, over 200 of them, and they are frequently now checking up, going there, visiting the place, sending us notes on what competitors are doing, and so you suddenly get a whole range of additional analysts keeping an eye on the investment. On the flip side of that, we have actual South Africans getting exposure to what's actually happening on the ground from a financial perspective. You'll see in both assets, the returns since our involvement have been quite, they've improved on both fronts. And we're quite keen and excited that our involvement is bringing to these businesses. So it's very exciting, and we hope to see that theme replicate itself in all the other assets we bring to the market, in addition to just giving the entrepreneurs the capital they so require.
Thanks, Ryan. Yeah, I mean, maybe now just unpacking the Altvest business as it's. I mean, when you guys came to market, there was a lot of fanfare around being access to alternative assets. Whether it was handbags, whether it was lodges, etc. But you've now been in the market for better part of I think a year, pretty much on anniversary at the moment. And I mean, people get a sense of what you're actually bringing to market, the challenges and opportunities that come with it. Two questions here, and I think they're interlinked questions. The first, I mean, what are you buying when you invest in Altvest? But then secondly, obviously your first set of financial results has come out, and somebody looks at it and says, all right, well, you raised 15 million and you lost 13 million, and I put lost in speech marks, because there's a treatment of that I think people have misunderstood. And maybe just some kind of clarity around what are you buying and what have you delivered, and how do you guys justify or define value created for shareholders?
So when you buy into Altvest, right, you're buying into an asset management company that manages a set of private assets on behalf of our investors. Now, those private assets are private equity stakes, and in time, in the next few weeks, will be debt products supplied to SMEs. So our job is to allocate capital in two instances, either as an equity check into an asset or as a loan to an SME that needs funding for a small set of reasons within our universe. You also get exposure to the transaction fees and advisory fees that we'll make. They've been quite muted up until now because we've had to pivot quite significantly because of the constraints on the retail investor. So we had to bring a product to the market that could accept large amounts of capital from the institutional markets, and those are now put in place. We're already starting to see inflows into those entry points. And that capital, like I mentioned in the start, will be allocated to South African SMEs with the intention is to provide them capital so they can grow their businesses, and that capital will be either equity or debt. In the equity instance, in certain cases, and it differs from deal to deal, but we want to mimic a private equity fund where we take some carry on the capital growth of the asset, and then asset management fees for assisting in the management of the asset. Now, where it gets confusing and it looks a bit scattered is we've had to create a number of entry points to accumulate capital. And so instead of just direct investing through a stock brokerage, we've now started the Altvest Retirement Annuity, which is a low-cost annuity product where people can have their compulsory savings allocated to this ethos of investing in the real economy and supporting South African businesses. For institutions, we've developed a number of instruments that they can enter through. Those include a pooled portfolio called the Altvest Opportunity Fund, and we're going to keep adding to the entry points. But at the end of the day, these are just access points to accumulate capital. Our job and our value add is deploying that capital effectively to SMEs that need it. With regards to the second question, we raised 50 million because that was the minimum listing requirement. Now, not all the capital was raised in cash. 50% more or less was raised in cash from brand new investors, but we also paid for services required to establish the business through the issuance of shares. Now, share-based payments, it's an accounting treatment, recognizes those as if I spent real cash. And that's why the actual expense line looks quite horrific. It's in line with more or less where we thought it would be. But it was really necessary to bring on people like Alec Hogg, partnerships like the Lion Cage, people like Bronwyn, various accountants and that sort of thing. And in the absence of these partners being able to contribute capital or cash, they were quite willing to be paid for their services in shares. We think the strategy worked. From a marketing perspective, I think you may not like us, you may not like our messaging, but the one thing that I think can be appreciated and admitted is that we punch well above our weight in terms of market exposure, given our age and size. I think there's a lot of there's a number of companies double our size that would happily accept or want our marketing exposure and for the market to know them as intimately as they know us. This interview, a case in point, I'm sure we're one of the smallest caps you ever end up speaking to. So we're quite privileged and appreciate the interest. And so we do feel that strategy has worked, not always as well as we would have hoped, because when you're under the spotlight, your zits and blackheads and all the other deficiencies are open for everyone else to see. And the South African public, and Twitter in particular, is quite severe when they point those deficiencies out. But even that we see as a privilege. We like being able to fix things, while the market's eyes are on us. It does make it exceptionally more difficult and more challenging, and makes us look a bit scatterbrained from time to time. But it is a privilege we enjoy and aren't going to stop doing.
Just looking at your cash flow, I mean, while I appreciate the expense line, I mean, looking forward 12 months now, you are burning cash, and a big portion of that is staff expenses. Obviously, you should have some revenue coming through. Is there, and I asked this question having looked, I mean, your shares is trading at just under $5 a share at the moment. Any risk, or maybe risk isn't the right word, but potential that you are going to have to go back to the market to raise some additional capital, or do you think that your revenue line will come through in the current year?
We think that within the next 3 months at least, revenue will start supporting cash flow entirely. We're very hesitant, me in particular, going to the market for more equity capital, because I think they'd be getting the shares at way too cheap. So for the time being, I've undertaken to fund any of the capital requirements of the business, but we are having quite a successful roadshow in terms of getting mandates from institutions. We think that will have manifested certainly before the release of our interims, which are due just after August.
Looking maybe now, I'm cognizant of time, so I want to just maybe run through some of your investments. I mean, your the first one that you brought to market was Umganu. It's obviously a tourism, there's a tourism recovery element to it. You have informed the market that this asset is for sale at the moment in terms of at the lodge level. Any kind of guidance around that, and whether or not you almost find yourself in a forced sale position in terms of looking at the cash flow question that was previously asked? Any kind of guidance there in terms of the strategy for this business?
So let me give you some background as to how the sale came up. When we raised the capital to pay for our portion, one of the mistakes we made was paying for the asset in advance. And the idea was we would collect that asset through the issue. We would get back the capital deployed through the issuance of shares. Now, we've gotten back about 8. So we've got, call it between 6 and 7 million almost trapped in this asset, which we're still actively selling. We sold another 2 million more after year end, which is in the financials. But during that sales process, we happened upon a number of people who were interested in buying the lodge outright. And one of those was a customer of Hamilton's, which is a luxury residential property agent. They then went out there and came back to us and said they'd be happy to sell the asset for us between 40 and 45 million. Now, it is slightly premature to realize the asset, but on the other hand, what we did think about was that it would be a wonderful proof of concept to deliver to the market, and exactly the kind of experience we're hoping to convey onto retail investors, where an asset is identified, it's mispriced, you can quickly raise the capital to get in, hold it for a period, run it for a period, make some improvements, and exit profitably within a very short space of time. Now, that's an experience that only the ultra wealthy or ultra connected get to have. An ordinary South African doesn't get to do that kind of thing. So we thought we would entertain a sale, even though it was outside of our sort of intended holding period, because it would deliver a fully executed proof of concept on what we were trying to do. And to that end, we were happy to entertain it. Yes, it would have the obvious benefits of a large cash injection, but that's not what's driving the sale. We think, given that it's a new platform, we would also benefit largely by having a full turnkey story where we can say we identified an asset, held it for a time, and exited and returned capital to shareholders or investors. And we'd be able to show the full investment cycle and return profit. So those are the main driving points. We wouldn't be interested in selling at less than 40 million. So we issued a cautionary. There were some investors offloading the share at R1 per share. If the sale goes through, that implies a price of between 180 all the way through to R220 per share. So we felt it appropriate to notify the public that this is happening. So please just exercise caution when dealing in the security. On the other hand, if we don't get the 40 million, we would also love the opportunity to show the market that we have the ability to improve the asset and its performance over that holding period, and then ultimately exit at a capital gain for all our investors. So either outcome has its benefits, but we're not opposed to either. It's certainly not been driven by a need to get cash. Like I said, our revenue projections, and when we project landing these mandates, make sure that we trade out of the negative cash position before the end of the calendar year.
Thanks, Ronnie. I think it's valuable insight around it, and I think proof of concept is, everyone has a plan until they get punched in the face, and it's nice to be able to actually show a story and show that there is actually something, a success story to work around. I actually thought this Bambanani story was quite interesting. I was reading through your results, and I was very surprised to see that you only attracted 61 shareholders. I thought it would be one of those things that would be quite appealing to a retail investor base. But to me, I thought it was I think it's really unique as in terms of being access to a real economy restaurant play. I am cognizant of time, so maybe just really focusing around one question here. You guys set out, I think, to raise about 15 million in the original prospectus. Came in at about half of that, I think, if I'm reading the numbers correctly. Does that change the strategy that was outlined in the overall prospectus in terms of what you want to do with this business?
Look, it would be an outright lie if I said we weren't disappointed with the take-up. But to put it into context, the day before the listing opened was when South Africa finally admitted to its citizens that we would have to endure load shedding for the foreseeable future. I think at the time the announcement was 5 years. So we had a list of interested investors who said, I was going to put in 20,000, 50,000, but I'm actually going to buy an inverter and a generator now because, so that happened. And we just finally started understanding exactly how constrained the South African retail investor is. Having said that, we raised sufficient capital for phase one of the plan, which is to develop the second, let's call it franchise, and that's underway. And we'll keep coming back to the market. But in addition to that, we have structured other entry points for retail investors. The retirement annuity, as an example, you don't need to keep your money with an RA that's charging you 12% per year. That's only in a balanced portfolio with no exposure to these kinds of assets. And that strategy is working really well. We've got over 200 applicants in Altvest Securities, which is the retail entry point for structured investments. And in the RA, we've got over 50 customers. So as those people's benefits transfer from their previous insurers, we're going to have more and more capital that deploys into each of the assets under administration by us.
And then Warren, I really just want to look, this to me is the real clincher in it, is what you guys are looking to do with this Credit Opportunities Fund, the relationship with Kisby. Maybe just a kind of 3-minute overview of what you're looking to do and what's coming to the market in the next couple of months.
Right. So just quickly, what happened with Kisby, now there were a number of shareholders, and not all of us agreed on, or had the endurance to see the journey through. So what brought an abrupt stop to Kisby was having to exit shareholders and almost start again. So the Altvest Credit Opportunities Fund is a renaming of what Kisby was. And the reason for that was we wanted a fresh start, and we also wanted to leverage off the brand awareness of the Altvest brand. So Altvest Credit Opportunities is just a rebirth of Kisby. And we leapfrogged the process of developing it all from scratch by acquiring the IP from Kisby. So that's the transaction. You see, we go at some length to explain it, but it has saved us at least 18 months just in terms of developing the engine room of what's required. So Altvest Credit Opportunities was a brand new incorporated entity that role is to execute the Kisby vision. But to do that, a lot of people contributed hard cash in developing Kisby. I think it's ethically and morally correct to, uphold my obligations to them and for them to get some return. And to that end, Altvest Credit Opportunities took over the IP and the associated liabilities that was, that actually supported the development of that IP. So I've tried to, where possible, where the ideas were transferred, to take on the liabilities so that if this works, I can pay the original funders of those ideas by returning their capital. So that in a nutshell is what Credit Opportunities is. We're going to be funding debt products for SMEs with a large bias to funding women-owned SMEs. And I think the market's going to love the way we've structured the offering, where if you employ the correct credentials, you actually get an immediate benefit in enjoying a lower cost of borrowing. So as an example, if you had to compare two SMEs and one had a female CEO and the other didn't, the company with the female CEO would enjoy a lower cost of borrowing. And so we've got 5 key empowerment credentials. And if you hit each of them, the one with all the credentials would enjoy funding at 25% less than the cost to people who didn't employ those credentials. So we think it's going to be massively impactful and reward people instantaneously for adopting the correct behavior to achieve gender equality in the country.
Yeah, we're very excited. We've been watching the communications going around it. I think we're quite excited. It's a space that we see a lot of opportunity for as well, and looking forward to focusing on that and watching it come to market. Warren, I'm cognizant of time, and I think it's really been appreciated to say thank you very much for joining us today. And we look forward to your interims and to get an update closer to with another 6 months under your belt. So I think, Warren, thanks very much for your time, and looking forward to engaging down the line.
Thank you so much, Marc. Always a pleasure chatting, and yeah, thankful for the time.
Have a good one.
Thanks, sir.
Cheers.